Futures higher at the moment despite new tariff threats from President-elect Donald Trump. I'm Katie Greifeld.
I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, it's deja vu. President-elect Donald Trump rattles markets across the world with more tariff threats. Meanwhile, President Biden rolls out a plan that would require the U.S. government to cover weight loss drugs. And we have a retail bonanza on our hands. We have a cart full of earnings as the holiday shopping season kicks into high gear. All of that and more coming up. But let's take a look at where markets are trading. 30 minutes until the bells ring. You can see futures a little bit higher at the moment. You take a look at the S&P 500 higher to the tune of about 0.2%. But then you take a look at the currency market and you can see that's where those tariff threats are really making a dent. You're taking a look at dollar Mexican peso right now. The dollar 1.3% stronger against the peso. We'll discuss that. But then you train your eyes on the bond market. We did see an initial pop when it came to yields, but now we're pretty much unchanged relative to where we were. The 10-year Treasury yield about 2 basis points higher, but we're still below 430, Sonali.
I leave you for a couple days, and there's just been a huge drop-off. Katie, we're going to get back to those retailers that you've been talking about here. A lot going on here. Kohl's now down almost 19% pre-market. It trimmed its full-year sales outlook, citing weakness in its apparel and footwear businesses. We're also taking a look at Best Buy as well, now down more than 2% pre-market. It cut its full-year comparable sales guidance on sluggish demand for electronics heading into the holiday season. The CEO calling things uneven over there on the path forward. Dick's Sporting Goods, though, here's an outlier, boosting its full-year earnings forecast after a strong back-to-school season. We're going to talk more about this in a moment. Dick's now up almost 10% pre-market. Amazing divergence going on in the retail world, Katie.
Yeah, it's really interesting. It's a real dichotomy that's emerged. You have winners and you have losers. Of course, one of the big losers being Kohl's. We'll talk about that. But Dick's, as Sonali was highlighting, seems to be an early winner. And then you have the likes of Smuckers, for example, managing to find consumers who are still willing to spend. And it's like we've been talking about, when it comes to the economic consumer landscape right now, you really can't paint with a broad brush.
It's kind of a cocktail of challenges here between the tariff strategy being proposed by the president-elect, as well as where the consumer stands, still facing some inflationary pressures. Really excited to bring our audience some of your CEO conversation over at Smuckers as well.
It's so interesting talking to CEOs, as we've been doing on this program, about how do you plan? You know, you have these missives posted on social media, Truth Social in particular last night, when it comes to those tariffs on China, Mexico, and Canada. It's really hard to know what you actually have to do as an executive making decisions.
And a lot of people finally saying, okay, the inflation impact, we will see how it goes. But in the near term, not planning is costly. Planning is also costly. We're going to talk about what these CEOs are planning for. President-elect Donald Trump had been quiet on his self-professed favorite word, tariffs, until yesterday, of course, because now for the first time since he won the election, Trump took to his website, Truth Social, yesterday to vow imposing tariffs on Canada and Mexico and raising them on China. Joining us now, Brendan Murray, who leads our global trade coverage. You did see some immediate reaction, right? You saw Canada's Justin Trudeau call the president-elect pretty much right away. But what are companies now having to do to prepare, especially with how much future uncertainty there is on any tariff policy above and beyond what he said just less than 24 hours ago?
Yeah, exactly. So we heard in Trump's first term a lot of these tariff threats delivered through social media and other ways. You can basically classify them in two categories. Some of them are threats, idle threats that meant to drive parties to the negotiating table or to try to achieve some sort of geopolitical outcome. And then there are some more sort of legitimate threats that we saw as well. I think you can classify this one, the the 25% tariff on Canada and Mexico and the 10% tariff on China due to drug smuggling and immigration problems that the president sees. You can classify these as bluster. A 25% tariff on Mexico and Canada would destroy the U.S. auto industry. So it doesn't seem even feasible that could go through. Whether he'll be successful in getting some sort of outcome from the three parties, the three top U.S. trading partners, is yet to be seen. But it's early already. He hasn't even been sworn in yet, and we're already seeing the tariff threats fly.
Well, I'm glad that you highlighted the auto industry, because you're absolutely seeing that reaction pre-market in those shares. But you highlight what is the key question here. What, of course, is a negotiating tactic, a bargaining chip, and what will actually turn into policy. Can we talk about Canada a little bit more, though? Because, of course, this seems to be about migrants. This seems to be about drugs. And actually, Bloomberg has reported that Trudeau pointed out to Trump that the number of migrants who cross the Canadian border into the U.S. is minuscule compared to Mexico. So how does Canada factor in here?
Yeah, it's hard to really understand what's behind Trump's social media posts like this, but you got to figure that the U.S. is in a free trade zone with Canada and Mexico, so he has to sort of include the two other trading partners. Canada is a huge exporter to the U.S. of energy, so you want to see your energy costs go up. Put a 25% tariff on Canadian natural gas imports, and that's exactly what will happen. Some of Trump's former advisors in recent weeks have even advised against doing that. So the fact that Canada was brought into this, I think, was just the NAFTA, the USMCA agreement, connects all three economies. So they had to be part of this. Yeah,
absolutely. And you're completely right. Oil, gas, energy, that is the biggest Canadian export to the U.S. So it'll be fascinating to see how this one evolves. Our thanks, of course, to Brendan Murray. Meanwhile, let's broaden out this conversation now and bring in Ritholtz chief market strategist Callie Cox joining us now. And Callie, Sonali and I were just talking about how difficult it is for C-suite executives, CEOs, to plan around the potential of tariffs. How should investors be treating this, some of which may, of course, be a negotiating tactic?
The CEOs, why not think of the strategists here? What we're telling clients right now is that all of this policy is just so far from being set in stone. Your prior guest just mentioned that Trump hasn't even been sworn in yet. So I think that's why we're seeing a muted reaction to these tariff threats in markets today. And, from somebody who has to talk about the data that we see and, refrain from speculating too much into the future, I think it's really just too soon to tell what's real, what's just talk. And, we have these stages, too, that all of these policies need to get through. Will these policies, come before Congress? Will Congress actually pass these policies? Some of them are being talked about via executive order, but we just don't know enough to really, factor that into our outlook. So we're just not, we're not trying to put too much weight in it at this time.
Callie, it's interesting. When I think about tariffs, I think about the potentially stronger dollar, even above and beyond where we have been seeing it. Katie was talking a little earlier about the dollar against the peso, among other currencies that would be very significantly impacted. But then you also think about the earnings picture here. Companies that make money not in dollars, that are American companies that have big presences abroad, including in China. That's kind of where we've seen the rubber hit the road many times before. Stronger dollar, weaker international earnings. How does this play out ultimately when you think about corporate earnings heading into next year? Basically, what do investors have to prepare for?
Where you're seeing the biggest effect from policy speculation, Sonali. The dollar's up about 6 or 7% since election day. And that's a huge jump. I mean, it doesn't sound like a lot, especially when, the other things we talk about are, Facebook or Meta and Nvidia moves. But, the US dollar is up pretty steeply since election day, which means that investors think that some of this policy will go through and it could weigh on the rest of the world. The problem is a lot of S&P 500 companies are global. S&P companies get about 40% of their revenue from outside our borders. So because of that, you really can't smite global trade for too long. And if anything, when it comes to tariffs, we're trying not to say too much, but we are highlighting for our clients what the risks of tariffs could be, since markets are, mainly focused on the rewards here of a pro-America policy promise.
Well, let's bring this conversation to the stock market. You correctly highlight that that kind of move in the dollar is huge for the currency market. It's not supposed to move that much. Another area of the market that's been moving a lot is those small caps. Basically, for that reason, the idea being that these are really domestically focused businesses. And as such, the threat of tariffs, maybe they're a little bit insulated here. At least that's one of the narratives I've heard to explain what we're seeing in the small cap space. How sustainable do you think that strength is?
Katie, I think that's one of the narratives, but the biggest narrative around small caps right now is deregulation. And the reason why I say that is because the sector that's been leading small caps by a mile has been those regional banks, those smaller banks. And if you think about regulation and the pressure of regulation on different sectors, banks have it the worst. And regional banks for so long have been held back by the compliance costs around regulation and the fact that as smaller banks, you don't really have many deregulated spaces to lean on when it comes to revenue and, trying to boost that net interest income and profit. So smaller banks are feeling the relief from possible deregulation. I think if it happens, of course, that's a big if, that could be a major, boost to those smaller banks. And it's hard to say what the boost could be right now without specific outlined policy or specific outlined plans on the deregulation front. But right now, markets seem euphoric around the potential for deregulation, and that's helping small caps. And I think that there is some rotation still going on between, large cap tech and the stocks that have done well to the stocks that have been a little more unloved this year.
Callie, we were talking about dollar uncertainty and how it impacts certain companies. I love Katie's point about the small caps as well. The other place that really matters cross-asset for small caps is the bond market. And you've seen just on the heels of the Bessent pick for Treasury Secretary, among other things, but largely because of that, a 12 basis point drop off in the 10-year. You were at 440 heading into the end of last week. You are now below 430. And how much of a difference does that type of bond market volatility make when you are investing in the equity market when so many of these companies still rely on leverage?
We did see a big move in the 10-year yesterday, but the 10-year is way too high. I think that's what markets are telling us across the board. And it's high for good reasons. Economic expectations were way too low in September and October, and then the economy hurdled them, which is a good thing. But right now, expectations are a bit high, Sonali. I think that's why you're seeing the volatility in the bond market that we're seeing right now. I don't expect this to be the end of it. Quite honestly, I think the 10-year could fall below 4% and, not shock markets too much just because there's been so much movement on the other end. But right now, what we're telling clients is that there's a lot of reward there, especially if you believe the economy is in a more moderate spot and isn't really blowing things out of the water right now. So see it as an opportunity, pick up on those classic recession hedges that we see in longer term treasury bonds. And don't try to overthink day-to-day moves.
Callie, we thank you so much for your time. Of course, always taking that measured approach ahead in what has been a very volatile market. Callie Cox from Ritholtz Wealth. Now coming up, a number of retailers reporting earnings this morning as we've been talking about it, and two going in completely opposite directions. We're going to take a look at those winners and losers next. This is Bloomberg. Now to high interest, a look at what's making headlines around the world. Starting with the scoop, Qualcomm's takeover interest in Intel is fading and is upending chances of one of the tech sector's largest ever deals. Complexities involved in acquiring the whole of Intel put Qualcomm off. That's according to Bloomberg sources. There is a possibility that Qualcomm comes back to buy just pieces of the chip giant. Meanwhile, we're going to talk about Intel securing $7.9 billion in federal grants from the Biden administration. The deal marks the largest direct subsidy from a program to boost U.S. chip production. Sources tell Bloomberg that Intel will get money for projects in Arizona, Oregon, and New Mexico. Shifting over to Walmart, joining a growing list of businesses here, reversing course on diversity, equity, and inclusion initiatives. The company will no longer consider race and gender to boost diversity when granting supplier contracts and stop collecting demographic data when assessing financing eligibility. Katie.
Let's also take a look at what's going on with the latest retail earnings, because we have a bonanza this morning. You take a look at shares of Dick's Sporting Goods, they're in the green. That's after they lifted their profit outlook. A similar story for JM Smucker, raised its earnings guidance, a beat and raised there on EPS. So that's the good news. Let's take a look at the bad news. You have Kohl's and Burlington all falling after reporting disappointing results. Here to recap all of it and give us some context is Bloomberg's Shelley Banjo. She heads up global biz coverage for us over at Bloomberg News. We have to talk about Kohl's. Down 19%, down 30% for the year through yesterday's close. This is a company that really needed some good news, and we did not get it this morning.
No, and it's going to take a little bit of time for this to turn around. I mean, they've had 3 CEOs or in 3 years, or will have the 3rd CEO that they just announced yesterday will take over in January. Every single time it's a promise of a turnaround, but that turnaround has not come yet.
Well, to that end, how much of this is a standalone story? Because they're talking about consumers having different preferences here. You're clearly seeing some of those preferences move over. You see, for example, Abercrombie & Fitch, yes, they raised, maybe not enough. We're seeing them down pre-market. But where are consumers actually going?
Yeah, I think it's a story of 2 sides, right? There's the haves and the have-nots. The consumers are being incredibly choosy. Inflation is still persistent. The growth might be slowing, but it still feels expensive. We saw that on the heels of the presidential election. Consumers are not feeling great about spending. The holidays are coming, and they're really choosing with their dollars. What am I going to prioritize, and what am I not going to prioritize? They're not going to spend any money, discretionary money, on things that are not most important to them.
And I want to correct myself. Abercrombie was down a little earlier, now up about 5%, more than 5% pre-market.
Yeah, it's pretty amazing. You take a look at that turnaround there. I do want to talk a little bit about how physicality factors into this, if at all. You think about department stores, and the close had a great interview with the CEO of Bloomingdale's, actually saying that basically the department store model needs to change. You think about some of the issues that Kohl's is facing right now. Obviously, a chain in department stores very reliant on that model. I just wonder what the future possibly looks like.
Yeah, you're seeing some of that success play out actually at Dick's. They're adding climbing walls, experimental reasons to bring you into the store. And then while you're there, you're throwing in a new bat, a new glove, whatnot. Kohl's has been trying to do that, bringing in these mini Sephora stores and these other tie-ins with Babies R Us, but it's not actually translating to sales around the rest of the store. People are just coming into that Sephora, buying that stuff from that Sephora, and then leaving the Kohl's rather than actually spending their money throughout the store.
It's interesting because a lot of the headline around Dick's was this back-to-school season. And I'm wondering how much the seasonality matters. We're heading into holiday season. A lot of us are going out buying Christmas trees after this. I mean, how much share can some of these firms gain heading into the end of the year with what you've said about the consumer?
Yeah, one thing we started seeing this season, which was different than in years past, is that people were spreading out their back-to-school shopping throughout the quarter and even saving some of that for holidays. So maybe not necessarily buying all the new backpacks and all the new sporting goods in September, but actually waiting, saying, I'm going to buy a little bit of it now, a little bit of it in the holidays. And so some of that is extending. That means the quarterly sales are a little bit more choppy in that way.
It's amazing that we haven't talked about tariffs yet, so maybe we should. Obviously, the talk of the morning, an additional 10% proposed on goods from China, 25% on all goods coming from Canada and Mexico. Of course, those are proposals. We'll see if they turn into actual policies. But what are you hearing from the American C-suite about how they're preparing for that possibility? We don't know specifics, but we know theoretically that more tariffs are coming.
Yeah, so I think that's the big dark cloud over this entire industry. And I don't think any investor that is putting money into retail stocks is not thinking about, okay, what is the tariff exposure here? We did see some very early companies, most notably Steve Madden, come out and say, we are already shifting our stuff out of China into different countries. But the question is, if the tariffs are going to be extremely high also in Canada, extremely high also in Mexico, where does that shift production? Because some of these items just can't actually be produced in the United States at this point.
And we've heard that over and over again. I keep coming back to that conversation we had with the Brooks Running CEO about how it's just so expensive to make things in the U.S. And we don't know the specifics of the tariffs, but we know it's going to be painful.
Right. It's really interesting. We keep on asking all these CEOs, what does that price of that sneaker that's $150 today, what is it next year? there. Shelley, we have to leave it there. We thank you so much for joining us. Of course, that is Shelley Banjo, leads our global business coverage. Global business is a hard place to be in right now, but of course, a lot of promise as well. We're seeing some of those stocks higher on the day. Coming up next hour, we're going to talk about the consumer, trade, and tariffs with Neil Dutta of Renaissance. Stick with us for that conversation. This is Bloomberg.
Welcome back to Bloomberg Open Interest. A quick check on futures right now. You can see the S&P 500, the NASDAQ 100 managing to poke into the green. The Russell 2000, it got so close to a record high yesterday's close, but now down a little bit. But let's go to the single stock level and let's talk about JM Smucker. Shares up 6%. Of course, they reported this morning they beat on EPS. They also raised their full year EPS forecast. And it was interesting, Chanel. I actually was on the phone with Mark Smucker. He's the CEO of JM Smucker. And he said they're seeing growth across all categories right now, including coffee, which was really interesting to me because coffee prices have been all over the place. Here's what he had to say specifically. Coffee still experiencing significant inflation. In fact, yesterday, for the first time in 13 or 14 years, they saw Arabica hit $3 per pound. So they did take pricing in June and October, but despite that, they had very good performance in coffee in the quarter. I guess it's one of those things you need to buy coffee, so that would help.
Inflation resistant. If you pull up a chart of Arabica over the 1 year, it's more than 70% higher in that 1 year period. So I guess people are getting used to these higher prices in certain categories. What did he say about some of the more classical brands like Hostess? So
Hostess, they recently acquired Hostess, and it's performing well, but they did say that because Hostess is a discretionary snack, one of the things they continue to see is pressure when it comes to inflation, discretionary spending. As such, they're launching $1 packs of small size portions, which is interesting. It's sort of like the fast food playbook.
Hostess deflation? Something like that?
Something like that. Really interesting, though. We'll cover all these stocks you need to watch and more at the Open, coming up next. All right, we are moments away from the start of trading on this Tuesday. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. You can see futures trying to shake off some of those rattles that we saw pre-market from those tariff threats coming out on Truth Social from President-elect Donald Trump, talking about an additional 10% tariff on Chinese goods, a 25% tariff on goods from Mexico, from Canada as well. You're seeing more of an impact in the bonds and the currency markets, which we'll get to. But right now at the stock market open, you can see everyone's clapping, of course. What this means for corporate America, still a big unknown. What this potentially means for the Federal Reserve if some of these negotiating chips actually turn into policy, also a big question mark. In any case, you take a look at these major indexes just a couple seconds into trading. You can see that the S&P 500 managing to climb about 0.2%, a little bit better if you take a look at your big tech index. The NASDAQ 100 higher by 3 to 0.4%. The small caps. It's such a sad story. We were so close to closing at a record for the small cap index yesterday. That would have been the first record since about November 2021. We didn't quite get there, and we're slipping so far this morning. The small cap's down about 0.5%. We'll see how that evolves. But let's take a look under the hood now, because we have to talk about retail, and we have to start with Kohl's, trimming its full year sales outlook, citing weakness in its apparel and its footwear businesses. You can see that is worth a 17-18% plunge. Then you take a look at Best Buy, cutting its full year comp sales guidance on sluggish demand for electronics heading into that crucial holiday season. That's another sad story. So let's end on a green note, because Dick's, meanwhile, it boosted its full year earnings forecast after a strong back to school season. That's good for almost a 3% gain, Sonali.
I am so sorry, Katie. I've got another sad story over here. We're looking at Zoom down another 7% as the market opens. Shares are falling after earnings didn't meet high expectations from Wall Street. The stock has climbed 60% since August and has been trading at its highest level since 2022. Also taking a look here at Rivian because it won preliminary approval for a $6.6 billion federal loan that will go toward constructing a factory in Georgia, made in America, right? You have Rivian up about 1.6%. We're going to stick with cars here because we're going to take a look at how Trump's proposed tariffs will impact auto markets with Bloomberg's Abigail Doolittle.
Well, not surprisingly, Sonali, we're seeing declines for the big automakers here. Ford, General Motors, and Stellantis all down. And of course, President-elect Trump yesterday talking about these tariffs, 25% tariffs in particular on Mexico and Canada. China, we don't know the specifics. So the reason the automakers are taking a big hit, Ford has 2 plants that produce roughly 400,000 vehicles per year. General Motors, many plants. Stellantis, not a U.S. company, but 27% of their autos are produced there. So these big declines. In terms of the particulars that I was just mentioning, it is also interesting. Baird is giving some color on what these tariffs could do. Of course, those autos and parts also made in China, but that it could actually cut sales by 1 million vehicles or more per year. So that could really be pretty painful. In terms of the amount of trading that the U.S. does with both Mexico and Canada. You can see for Mexico, it's closer to 130 billion. Canada, it's 104 billion. Now, what's really interesting, Katie, some of my sources have told me that China in the past, prior to the previous Trump administration tariffs, that trade number would have been much bigger, but that China has started to export some of its goods to both Canada and Mexico, and then they come into the U.S. So it's going to be interesting, of course, to see how all of this plays out for the U.S.'s biggest trading partners and the tariffs that appear to be ahead.
Yeah, you can absolutely say that again. Abigail Doolittle, thank you so much. A quick check here on shares of Amgen, really plunging at the bell right now. Of course, we saw weight loss shot results from this drug maker. They have an experimental obesity shot. It did help patients lose up to 20% of their body weight in this year-long trial, but potentially more side effects than investors had been hoping for. Interesting, of course, on the same day that President Biden is proposing Medicare and Medicaid coverage of obesity drugs. We're going to unpack all of that in just a little bit. But let's get back to that tariff discussion and what it means for the markets, because I'm pleased to say that we're joined now by Jim Caron. He is the CIO of Cross Asset Solutions over at Morgan Stanley Investment Management. Jim, it's great to see you in person.
Great to see you.
Let's start with tariffs.
Okay.
Of course, we were having the conversation earlier, how much of this is actually going to turn into policy, what this means in terms of bargaining chips, but how are you thinking this through as an investor with the information that you have right now?
So it's very unclear. I mean, you know, Trump's been talking about tariffs for about 2 years. Here he is now president-elect. And I don't think that we should be surprised that this is top of mind for him. Obviously, the timing and the release of these things that come out. Look, 25% on Mexico and Canada. Is this a bargaining chip? Is this just a prelude? Is this an opening ante to the whole discussion that we're going to have? It probably is. And I think the risk that the market has to really face right now is taking these things verbatim and extrapolating it into the future and saying, well, then that means this, and then that means this, and you create this path of uncertainty based on a statement that we don't really know the full validity or the full heft or how deep he's willing to go, or is this just a negotiating tactic? So I think the market's reaction is appropriate. They took it at face value. They said, okay, it's a tariff. Let's see how this plays out. And as we can see from the bond markets and we can see from the equity markets, it's not really creating too much disruption.
But should it be? I mean, if you think about it, if you're a CEO, you're navigating a company, might be a multinational one, you have the president-elect saying he's going to do something that is well above and beyond what they have seen before. Don't you have to prepare for that? And if you have to prepare for it, wouldn't there be a read-through effect to the consumer that is buying their products?
Absolutely. So I think that most of corporate America has to be on the defensive, because the other aspect of this is, where are these tariffs going to be targeted? Is it just an across the board all the way through every single product, or is it going to be more targeted, or is there an objective in mind? In this case, it's immigration and fentanyl, and it's all these various things, right? How does that play into the discussion as well? So as a CEO, you do want to prepare, but what exactly are you preparing for? I mean, I think that you effectively say, I've got to be a little bit more cautious, build in some more cash, build in some more margins. I have to protect myself. But I think that's about as much as you can do, because there's no real details to the policy other than just a broad statement.
Actually just had that conversation with Mark Smucker. What are you doing? And he said, all we can do right now is scenario plan. We don't actually know what's going to happen. But you take this cross asset, which of course is your specialty. So there's the stock market piece. There's the reaction in the currency market. It seems like we're seeing more follow through in certain pairs such as dollar peso, dollar loonie. But the bond market, not a huge reaction here. Is it already priced?
Well, here's what's very interesting, right? Here we are talking about tariffs. And yesterday, we had 10-year Treasury yields fall 10 basis points. Yesterday, we had the yield curve flatten and actually invert. It re-steepened just overnight. So all this tariff talk, based on the bond market, based on the shape of the yield curve, based on what's going on in bond yields themselves, seems to be relatively well socialized across the markets at this point. So, is this going to create the inflation impulse that people think? Well, so far in the bond market's really not really saying that it is at this point. Now, maybe it's already priced. Now, don't forget, bond yields came from 360, 370, a few months ago, and here we are at about 4.3%. It's a very, very painful move. So maybe this adjustment, as people built in a Trump victory, has already taken place, and we're kind of at this risk premium fair value point for the bond market to absorb this information about tariffs.
So whether it's the bond market or the equity market, what is not yet priced in? Where's the tail risk here?
So I think the tail risk is actually it actually is an inflation impulse, right? So far what we're seeing is that inflation's coming down. We're going to get some PCE numbers. They should come out, relatively close to expected. But if there is an inflation impulse that comes from this, that unravels everything, because that stops the Fed from cutting interest rates. And lower rates is one of the things that's keeping multiples in the equity markets and valuations relatively high. It also would suggest that if we have a weakening labor market as we go forward, right? So it might be a hit to consumption. You could have a weakening labor market as a result of that. All of these things can really snowball and become a very, very bad scenario. And that's the tail risk. So far, it's early days, and we're not there yet.
Well, just to tie a bow on that thought, the fact that an inflation impulse would unravel everything, what market is least prepared for that? You think about some of the asset classes that really have been banking on inflation coming down. Where would that potentially hurt the most?
I actually think it's going to be in the credit markets for the most part, right? So the most overvalued asset in the marketplace today is probably the most vulnerable, and I would say that those would be investment grade and high yield credit spreads. Those spreads are extremely, extremely tight right now. So if we were to get an impulse towards higher interest rates, I think what we would also see is those spreads actually widen quite a bit. So not only are you not getting enough compensation in high yield and investment grade because of the tightness in spreads to take on this risk, but if there's a widening in spreads as yields go up at the same time, that's a double whammy for that market. So I think we need to be a little bit careful about our bond allocations in the investment grade and high yield space. Equities, the pricing, the margins, they have a little bit more wiggle room, but investment grade and high yield at these tight spread levels don't have a lot.
Yeah, markets very much shrugging off a lot of risk in those markets all year long, really. Jim, we thank you so much for joining us here on set. That is Jim Caron of Morgan Stanley Investment Management, going all across assets for us, a lot of complicated things to consider. Now, coming up, weight loss drugs spike. The stocks, at least, on Biden's proposal to cover obesity drugs under Medicaid and Medicare. You can see that movement there, and we're going to talk about it all next. This is Bloomberg.
Welcome back to Bloomberg Open Interest. A quick check on stocks. The S&P 500 mid-pack right now. Your big winner is big tech. The NASDAQ 100 up about 0.5%. Your small caps, the biggest loser, at least at this moment. This has been the leader in the markets, but at least for today, the Russell 2000 down about 0.6%. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, TD Cowen initiating Pinterest with a buy rating. The firm says that the online search platform is using large AI models to drive more relevant content and ads that should drive Longer-term monetization, Pinterest pretty much unchanged at the moment. Next up, we have Daiwa saying that Target is no longer a buy. The firm downgrading the retailer to neutral, also cutting its price target by $40, with the analyst citing persistent uncertainty when it comes to the company's outlook. And finally, we have Baird initiating coverage of Bright Mind Biosciences with a buy rating. The biotech company is advancing into a new phase of testing for its epilepsy treatment, and the analyst says that the company's recent acquisition of Longboard Pharmaceuticals is also a positive catalyst. You can see shares up about 8.5%. Meanwhile, let's turn to the pharmaceutical stocks right now, such as Novo Nordisk and Eli Lilly, climbing in a big way this morning because the Biden administration is proposing a rule that would require the government to cover weight loss drugs through the Medicare and Medicaid systems. You also have Viking Therapeutics higher as well. Amgen, meanwhile, down in a big way after the obesity drug trial showed disappointing results. We're going to discuss all of this right now with Bloomberg Intelligence analyst Sam Fazeli joining us. And let's start with Medicare and Medicaid and get into the politics of it all, because one of the big questions over the rally that we're seeing in Novo and Lilly today is whether the Biden administration will actually be able to push this through in time.
Yeah, I think there's going to be quite a lot of people who want this to happen. It's not a very large ticket, $35 billion over 9 years. If you think about the size of the Inflation Reduction Act and the money involved there, this is a drop in the ocean. It is a clear benefit for people that are Medicare enrollees or covered by Medicare. And therefore, I think it just makes a lot of sense for the health of the nation, too. The question, of course, is whether, if this does get put through, whether RFK Jr.'s views with regards to obesity drugs in general and how people should really lose weight, which is diet and exercise, which of course we've been trying to do for the past 30, 40 years with no success from a society perspective, whether he will be able to push against it as time comes. But we're optimistic that it will stick.
Sam, who are the winners and losers in this scenario? You did see differences in how the stocks were performing. And of course, you coincidentally had a separate set of headlines coming out of Amgen this morning, the stock being very significantly impacted here after its experimental obesity drug failed to outperform rivals, showed a high rate of side effects. What's the issue for Amgen here, and how do others gain, frankly, at their expense?
Yeah, so this seems to be happening on a regular basis. It was AstraZeneca, it was Roche, it was Amgen, coming with new data, going to dislodge the incumbents, which are, of course, Novo Nordisk and Eli Lilly. And of course, these are folks who've been on the market with drugs for first diabetes and then obesity for several years, over a decade, with safety data, with physician understanding. Everything is in place with several indications for their products as they're going along, and success in various areas of disease that are related to obesity. So the market still likes to worry about this new data coming from company X, company Y. And then, of course, the data comes, and it's hard to go beyond the 20-25% weight loss, which is also Novo Nordisk has got some data coming before the year end for a new drug themselves. So when the data comes out and it looks okay, but it's no magic, and side effect profiles look questionable, there's data points that are not being dissected correctly, and that's what happens. Stock sells off, and the others, and people remember, Lilly and Novo lead this market.
Yeah, you're absolutely right. And you have a ton of also-rans trying to catch up to that lead that those two companies have. I want to go back to the politics of it all, though, because we're talking about Medicare and Medicaid potential coverage. Let's talk about potential government price negotiations under the Inflation Reduction Act, because semaglutide, of course, was expected to fall under that. And our reporting has shown that the proposed rules for Medicare and Medicaid would go into effect at the same time that the program to lower medication costs through price negotiations would happen. So there's a lot of different cross currents coming together here. What does this ultimately mean, Sam, when it comes to access, when it comes to price?
Yeah, I mean, look, these obesity drugs have got good safety profile. Tolerability profile is a slightly different question, but safety, meaningful safety is there. They significantly reduce weight, and they really help people manage quite a lot of the side effects, if you want to call them that, of obesity. At the end of the day, the easier it is for people to access these drugs, the better for society as a whole, and the better for our eventual savings of costs associated with the diseases that result from it in 5, 10, 15 years' time. So whether it be Medicare coverage, whether it be reduction in price due to IRA coverage, at the end of the day, we do have an epidemic of obesity, and we need to deal with it. And therefore, the assumption is if prices go down, demand will go up, and therefore the companies should still be able to succeed with their revenues and also to continue to invest in the space to get better drugs.
Sam, we thank you so very much for your time today. Of course, that's Sam Fazeli of Bloomberg Intelligence breaking down a very, very busy day in the world of healthcare from Washington, of course, to the C-suite. We're going to also bring you some breaking news here. The president of Mexico is speaking at a daily news conference hosted on YouTube from the National Palace in Mexico City. Some of the headlines coming out of that event is that she is seeking to meet as soon as possible in the wake of those headlines just a day ago from the president-elect about those tariffs that may be imposed on Mexico. She says she is of the view that they will reach an agreement with the United States. Tariffs will follow other tariffs, she said, hurt other companies, and that U.S. and Mexico must cooperate to resolve these joint challenges including migration, fentanyl, and she is going to be sending a letter to the president-elect on migration and fentanyl. Katie, I know this comes just a day also after we know that Canada's Justin Trudeau had a call pretty immediately with the president-elect.
So we got the Mexican response, of course, from Mexico's president. We know that Trudeau and Trump held a phone call. Reporting suggests that it was, quote, productive when it comes on trade. But even still, I mean, you take a look at how the stock market is taking this. GM shares extending their decline down almost 8%, the most since June 2022. So we'll see. The leaders are talking, but stocks are reacting nonetheless.
Right. We were talking about it. Maybe not a broad-based response in stocks, but certain stocks certainly feeling that pain. Now, coming up next, we're going to talk about the world of finance, a novel way to find the next whiz kids on Wall Street. We're going to bring you the details in our Wall Street Beat next. This is Bloomberg. Time now for the Wall Street Beat. We're looking into world quants competition to find the next generation of finance geniuses. It's the subject of today's Big Take. Bloomberg's Justina Lee co-wrote the story, joins us now. We love covering quants here on this program because it does say something about the differences in opinion of the skills you need for the future. What are the skills that you're seeing? Of course, World Quant is backed by Izzy Englander's Millennium. They have been known to really mint math geniuses over many, many years.
Yeah, I think what's kind of really interesting about what they're trying to do here is that essentially they kind of want kids and, like anyone all around the world to try to actually do what quants do, which is to crunch data in search of trading signals. So they've built this crowdsourcing platform here where anyone can kind of play around with the data that they have in order to find those signals. And if you do well enough, you might even get paid. And so it's quite an interesting new model that we're not really seeing in a lot of places to crowdsource alpha at a time when, hiring actual Wall Street talent is costing, a lot of firms so much money.
What does it say about the future of talent, Justina? Because the signals tomorrow will be different than the signals of yesterday. I mean, can people of this kind of generation of quant be as successful 10, 20 years from now when the math is just faster?
Yeah, that really is sort of the big question here. And I think sort of what World Quant is sort of betting on is, at the end of the day, they always say, talent is global, but opportunity is not. But these days, there is a lot of machine learning and statistical talent that's kind of all around the world. And I think in their vision of quant finance, you don't actually need to know that much about the stock market, or you don't actually need to read Bloomberg, for instance, because at the end of the day, it's all about crunching the data. Right. But they do clean up the data in advance for you, and then they're just counting on you to kind of work your statistical magic on those numbers.
All right, Justina Lee out with yet another big take. Someone stop her. Great reporting as always. You can find that on the Bloomberg terminal or on Bloomberg.com. Coming up in the next hour, we'll talk to Neil Dutta. We're going to speak to the CEO of Lloyd's America And then we're going to talk to Brandon Yarckin of Universa Investments. Don't go anywhere. This is Bloomberg. All right, 30 minutes into the U.S. trading day. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today.
Let's get a check on these markets. We're awaiting some consumer confidence figures. And as we wait, the S&P 500 a little bit higher right now to the tune of about 0.2%. Big tech up a little bit higher as these numbers roll in on the conference board. Consumer confidence, it looks like a touch light, but pretty much bang in line. Let's get the details now with Bloomberg's Mike McKee, our policy and economics correspondent. What did we learn?
Well, I don't know that you can accurately forecast what consumer confidence is going to turn out to be, so let's just call it good news. 111.7 is the reading. That's up from 108.7 the month before in October. That was revised to 109.6. So an increase in overall consumer confidence. New home sales, 610,000, big drop, 17.3%. From the month of September. These are October numbers, and that is a problem, obviously, for the home building industry. We're seeing a lot of data that suggests that things are getting really, really tough. You can see there home affordability going up in price, and that really makes a difference to what people are able to purchase. We did see prices for housing, according to FHFA, rise 0.7% last month, 4% on a year-over-year basis, according to the S&P CoreLogic Case-Shiller numbers. So overall, problems on the housing side, but consumer confidence comes in better. 140.9 for the present situation, 92.3 for the future outlook, and those are both better than they were last month.
Glass half full can see also that average 12-month inflation expectations, McKee, had declined to the lowest since March of 2020. People also are fearing a recession less. It looks like they're excited about job availability. What do we know here about the push-pull between what we're seeing in consumer confidence and the outlook on the job market?
Well, consumers' expectation of the labor market, 33.4% say jobs were plentiful. That's down from 34.1%. That is a kind of significant drop during the month. 15.2% say jobs are hard to get, though, down from 17.6%. So most people are saying that there's been little change in the labor market. The problem for us is next week we get the jobs report, and we have seen a big rise in August, a big drop in September. So what do we get for the month of November? We don't know yet.
All right, Mike McKee, appreciate your perspective. As always, you can see Treasury yields climbing a little bit in the wake of that data, now camped out about 430 on the 10-year yield. But let's turn back to retail. Of course, it's a big day for retail earnings, and one of the names that we're keeping an eye on is Abercrombie & Fitch. The retailer is still growing, but not fast enough for investors. You can see shares currently down about 5%. We had been higher to the tune of 5% pre-market, but a lot of volatility coming through in what has been the superstar of this category. Let's get more now with Mary Ross-Gilbert of Bloomberg Intelligence. Curious to hear your perspective here because they reported record net sales. They raised their full-year growth outlook. Seems like the bar was just very, very high for Abercrombie.
Yes, Katie, the bar was probably very high, but frankly, they're delivering on it with comp sales up 16% and Hollister up 21% when analysts were expecting just 11%, is showing that this management team is executing well and giving their core millennials, which is the Abercrombie & Fitch core cohort. And then if you look at Hollister, that's Gen Z. And they're providing the merchandise, the collaborations. They're across social media. I don't know if you saw the TikTok with the Las Vegas Grand Prix and the McLaren partnership that they have. And so this is sort of like the second. They had some exclusive product drop in a store in Las Vegas for that collab. And all of these things that they're doing, but particularly really meeting what their consumers want. They're listening to them and providing it. So actually, we think they're continuing to deliver better than expected. And certainly their results beat estimates, maybe not as high as analysts had expected, but I think we always see volatility around earnings, and I think we're going to continue to see good execution out of this company. And with the warm weather having affected most apparel retail, wow, I think they hit it out of the park with those numbers in the third quarter.
Well, to that end, one retailer that did blame the weather was, of course, Kohl's. And if the bar was already high for Abercrombie & Fitch, you could argue, Mary Ross, that the bar was very low already for Kohl's heading in, having that the stock had dropped 36% heading into this morning and now is down 50% on the year. How much of a struggle is there to turn things around? You could see the stock now down almost 22%, more than 22% today alone.
Yes, Sonali, you're right. With Kohl's, whenever a company reports comp sales down 9.3%, and with those numbers, the actual Sephora beauty business on a comp basis was up 9%. So that shows you that they had double-digit declines in their core apparel categories. The reason for that? While they were bringing in new categories, new home business, they also debuted about 200 Baby R Us shops. And then they also have gifts and impulse items. And although those categories, small and new and improved, did show increases, where they saw the weakness was in private label, because private label, they reduced inventories, I think, over 20%. And that's what their core consumer, still strained by inflation, even though inflation, going forward looks to be in control, they still are having to pay high food prices and gas prices at the pump. So that affected their sales. And as they moved through the quarter and they boosted private label, they saw their comp sales improve 500 basis points. So this also led to a new CEO. So they have brought in Ashley Buchanan. He's the CEO over at Michael's, the crafts retailer. He's known for having executed a great turnaround there and really improved the profitability and cash flow of that business, and is now going to be joining Kohl's effective January 15th. Tom Kingsbury will be transitioning to a consultant role until his contract expires in May. Yeah. So we think that's the reason for the transition, although Tom really did have just a 2-year contract that was ending in May anyway. And he's really done a great job at Kohl's, but I think there was some misexecution, and that really showed in the third quarter.
Yeah, big time. And we have seen so much turnover at the top when it comes to Kohl's. Ashley Buchanan, of course, really has his work cut out for him. But let's look ahead. We've already gotten a ton of names so far today, but we have Nordstrom after the bell today. And it's interesting. You take a look at shares right now, currently down about 2.5% before we get those numbers. What are you expecting to see out of Nordstrom?
When we look at our consumer transaction data, we're showing that they could actually beat estimates, but we think they're also going to have the weather impact. And we know already that they're going to have a negative effect associated with their anniversary sale, because there's going to be less of those sales this year versus the prior year. So there's that headwind. I think it's about 100 basis points. Other than that, we think they should show good sales, and we're thinking Full Line probably did okay. But we'll find out more when they report after the close today.
Mary Ross-Gilbert of Bloomberg Intelligence joining us, of course, on a very, very busy day of retailers. We're going to go move and take a look at stocks moving this hour outside of the retail world. Here's Abigail Doolittle.
Let's take a look at the home builders, because we did, of course, just have breaking data on U.S. new home sales for the month of October, and it was a pretty significant miss. The number came in at 610,000 homes sold in the month of October, new homes. The estimate had been for 725,000 homes to have been sold, so more than 100,000 homes in terms of a miss. And of course, over that time period, rates really went sky high in anticipation of a Trump election, which did in fact occur. But that Trump trade, and so you can see the home builders really at session lows at this point, down 2% or more on this breaking news. Turning to the shares of Zoom, well, they're down too. They actually beat and boosted, but given the fact that the stock was up more than 65% from the August lows, the expectations a little bit lofty, that stock falling too far, too fast. And then finally, we have a tale of two stories for some of the big pharma companies. We do have Amgen down right now 11.4%. They had disappointing data for their weight loss drug shot. Folks who used it in the trial, they lost 20% of their weight, 11% dropped out. So side effects, not as much weight as investors had wanted to see that drug produce. Eli Lilly, though, you can see up about 4% in part because of the possibility of less competition.
Abby, we thank you so very much. And coming up next, we're going to go from the micro to the macro. We're going to talk to Neil Dutta of Renaissance Macro, who's going to break down what Trump's tariffs could mean for markets. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Target is hoping its $25 leggings will give the struggling retailer a swift kick into high gear. The all-in-motion brand pants have amassed a cult following online since their debut last fall, helping Target's athleisure business grow by double digits. The retailer set out to compete in quality and fashion with the likes of more pricey brands such as Lululemon, where leggings start at about $100. We know that Target has some inventory issues, so we'll see if maybe this offsets some of that. But next up, the Peacock is going to have to pay up. NBC may be forced to swallow triple the yearly fees it pays if it wants to keep exclusive rights to air the Macy's Thanksgiving Day Parade for the next decade. The network may have to fork out an annual fee of over $60 million. That's up from $20 million that it currently pays. The golden goose in this case is the 30 million TV viewers that tune into the 100-year-old parade every year. And finally, California's plan to offer EV tax credits if President-elect Donald Trump cuts off federal incentives has a catch. It may not include rebates for customers of Tesla, one of the most popular cars in California. The move, of course, has elicited a strongly worded response from the company's Trump-friendly CEO, Elon Musk, who called the move, quote, insane, Sonali.
He called it insane, and it's interesting. You can also see the divergence in the stock reactions today. It is also pretty insane. You're seeing different treatment among different companies. So, for example, not only do you have Tesla that would be left out of that incentive program over in California, if they're able to really bring some of that money back to consumers, you also see separately Rivian winning a preliminary approval for a $6.6 billion federal loan that would help it build an EV factory here close to Georgia, in Georgia. You have a $6 billion loan that they're talking about with $600 million of capitalized interest. And it's interesting. This is to level the playing field. I think a lot of people after the election really just bet on Tesla as a way to bet on Musk. And now this is both government entities, governors telling you they want the playing field to be more level.
I will say, what a day for Matt Miller to call out. There is so much auto news right now between, of course, the EVs and also just the traditional automakers. You think about those proposed tariffs from President-elect Donald Trump really hitting the automakers hard, including the likes of GM. We were talking about this. Basically, we don't know what's a bargaining chip, what's a negotiating tactic, what will actually come into fruition. But as you can see, you made the great point that it's not making a dent really at the index level, but the single stock level. I mean, investors are reacting. Who knows what's going to happen?
They sure are. And what we're not showing here, too, is the move in Tesla you're seeing today. It is still up 1%. So you're seeing traditional automakers really lose out, and EV automakers really have a pretty decent day, frankly, all things considered. At least, Katie, we don't need to talk about hogs today.
That's true. We're staying away from motorcycle talk, but yeah, plenty of news on the automaker space. And it's nice because it gives us something to talk about because the broader index is kind of a snore right now. It seems like everyone is just very much in holiday mode.
Yeah, and it's interesting. And not factored into those stock prices also is the energy picture, which we'll save for another day. But coming up now, where we said give you the macro, we're going to bring in Neil Dutta of Renaissance Macro to break down what Trump's tariffs could mean for markets well outside of that auto industry. We're going to bring that to you next. This is Bloomberg. Now, we've been talking about a lot going on in the world of policy, and it's impacting corners of the market today. A lot of uncertainty on where it's going to impact the markets next. So we're going to bring in now Neil Dutta. He's the head of economics at Renaissance Macro. When you're parsing through the uncertainty of some of the policies being proposed by the president-elect, there's a lot to talk about. Everything from the tariff policy to Scott Bessent's 333 plan. At the end of the day, what in your mind will be the biggest change coming into the next administration that will impact markets in a way that investors are not accounting for today?
Well, I mean, it's important to remember that after the election, you saw this sort of big reflation trade get put on, particularly in the fixed income market. And I think it's an open question about whether the incoming administration can meet the expectations that are embedded in the fixed income market. I mean, it's important for people to remember that the majorities that the Republicans have in the Congress are actually quite thin. I mean, particularly in the House. So getting legislation across the finish line, I think, is going to be a particularly tall order. At the same time, I think, you know, the administration doesn't have that many fiscal levers to pull. I mean, I would argue that the previous administration went to the fiscal well one too many times, and that's kind of kneecapped the incoming. I mean, remember, every time you get a new administration, it's always something, right? I mean, it's W had the tax cuts, and then President Obama had a Recovery Reinvestment Act. Trump had TCJA, and Biden had the ARP, CHIPS Act. I mean, so that sort of big bang type of stimulus, I don't think is likely. And, you know, I think that that's probably a good thing, frankly, because, you know, for me, what they really should be doing as much as possible is trying to brand some of the Biden policies as sort of the new Obamacare. And we're going to repeal and replace it. And that'll free up the space to deliver on some of the fiscal items that the administration wants, like extending the tax cuts and so forth.
Well, there's a lot to dig into there. Let's talk about what's priced into the fixed income markets, because we were talking about this with Jim Caron. We've seen this incredible rise, particularly in the long end. When you take a look at the Treasury going from 370 to 430, where we are right now, if there's not many fiscal levers, TBD on that one. I mean, are you saying that we could be set up for a rally in the bond markets if some of these don't come to pass?
Yes. I think that there's probably room for fixed income to rally, you know, between now and, frankly, you know, the end of the first quarter. And I also think that there's going to be a need to kind of focus on the here and now, not so much speculate on what may happen next year.
But that's what we do.
Well, sure, but I think bond markets, I think, have gotten a little bit thinking too much on the outlook and not focus on what's going on right now. And we see that the administration, the incoming administration, is not really inheriting a rip-roaring economy. I mean, people want to talk about the economy being strong, but on my way over here, I just saw new home sales collapse, right? And that's a reminder that interest rates are high, and that's making it very challenging for people to put, you know, to make the affordability math work for housing.
I think one thing that's really frustrating for a financial journalist, you're talking so much about the Fed, and those long-term interest rates have been decoupled from the Fed's next move. And if you're thinking about mortgage rates, they're tied to those longer-term rates. So if you think there's going to be a significant bid in the bond market, where does the 10-year end next year? And where do mortgage rates go on top of that?
Well, I mean, I think 10-year yields can have scope to probably rally to 4%. I mean, between now and, you know, the next month or so. You know, I think that that's eminently possible. You know, I also think that the labor markets aren't out of the woods either, right? I mean, so if you look at things like labor demand continues to slow. If you look at job openings, for example, they're weakening. Hiring intentions remain sluggish. I mean, you know, you talk about the animal spirits. But in many cases, maybe there's some more optimism on the part of businesses and consumers after the election. I mean, that's possible. But if you ask businesses, what are you doing? Well, we're waiting to see what they do. Well, then if that's the case, then you're just basically stuck in place, right? So I do think that you'll probably see more Fed rate cuts. Where people are talking about a pause, I think they still go in December, and I wouldn't be surprised to see them doing a few more, early on before the end of the second quarter.
Neil, I do want to talk about Treasury as well. Part of the reason I really wanted to have you on was because you've been putting out these passionate notes, I think I'll call them that, seemingly in favor of Scott Bessent. He has been confirmed as the pick for Treasury Secretary, and the narrative yesterday was that maybe he would sort of temper some of Trump's most dramatic impulses when it came to the tariff picture. That narrative is in question today. How do you see that push-pull working out?
Is it? I mean, I think, it is, I guess, fun in some respects to go back to trade policy by Truth Social post as opposed to tweet. But I would say if you read that, what he wrote, it sounds in my mind a lot like the escalate to de-escalate approach that Bessent has been talking about, right? And, sort of a vague off-ramp that allows them to claim victory before any tariffs are actually put into place. The reason why I thought the pick for Treasury was so important is because this is not like 2017. There is no Paul Ryan and Mitch McConnell with a stack of papers for Trump to sign. This is different, right? The legislative agenda is really coming more from the brow of the White House now, not the Congress. And
there's not that moderating influence.
Well, I mean, I just think that the agenda is being set more from Trump himself than the Congress. That's why this is different. And so that's why the stakes on these picks are much higher, right? So that's what I was trying to get at. And to me, it was so obvious that you may not like the candidates that are out there, but among the candidates that are being presented, it was very clear to me who the best man for the job was. And that was Scott Bessent. Now, if you went with someone like Warsh, I mean, how is that going to work? You're going to put in someone that clearly wants another job.
Right.
So I think getting that call right was very important.
Well, we'll see what happens in 2026 to that point on Kevin Warsh. Neil, not enough time. Come back soon. That, of course, is Neil Dutta. He is head of economics over at Renaissance Macro. Coming up, we'll speak to the world's largest insurance marketplace, continuing its growth here in the United States. This is Bloomberg. Well, extreme weather is taking a toll on the global economy. A recent report estimates extreme weather events have cost the global economy over $2 trillion, and the U.S. tops the list with the biggest losses. Here to talk about how to build weather resilience into the insurance industry, I'm pleased to say we have Dawn Miller. She is Lloyd's Chief Commercial Officer. She's also CEO of Lloyd's Americas. And Dawn, it's great to have you with us. I want to just set the scene here because Lloyd's, it's a subscription market, and investors in the U.S. may not be as familiar with that model. So just to start, explain to us a little bit about what a subscription market is and what Lloyd's actually does.
Absolutely. Thanks so much, Katie. I so appreciate being here today and having this opportunity to share. Just taking a step back, Lloyd's is the world's leading and possibly largest insurance and reinsurance marketplace. We have over 100 insurance companies operating in our sphere, with another almost 400 intermediaries or brokers that feed into that business. We operate all over the world, and we're licensed in 200 territories. So when we're thinking about a subscription market, what that allows us to do is individual talents, the underwriting companies, can join together to address some of these larger risks, especially like some of the larger climate-related risks and other supply chain, geopolitical risks that we see around the world today. Those markets can come together in a framework that we've sort of already built, if so to speak, and take those risks so that the capacity they're putting up, the risk that they're sharing, and the risk mitigation measures they're putting in place are relevant enough to deal with some of those large-scale risks that we're seeing out today. Not necessarily always in the millions, but in the billions.
All right, that is definitely helpful context. And I want to talk about a little bit about you because you're the Chief Commercial Officer of Lloyd's overall, but you're pulling double duty because on September 1st, you started as the CEO of Lloyd's America. Talk to us a little bit about what you're doing in this new role, this expanded role, and what your priorities are heading into 2025.
Thanks, Katie. So Lloyd's, as I mentioned, is a near $70 billion marketplace. Over 60% of the premiums, so where we're taking risk, come from the Americas region. The singular largest part of that is coming from the United States, and we're seeing that the volume of complex risk needs increase exponentially in the United States. So we want to make sure that our intermediaries and our clients and those around us understand Lloyd's, that we create accurate pathways into Lloyd's, and we somewhat demystify the marketplace, as your opening statement mentioned, for the capital that's seeking to also take risk. Lloyd's is a marketplace, for those that are not familiar, we've been around for a long time. We got started as a marine market 330 years ago. So that volume of talent concentrated in one place allows us to quite easily at times, or quite comfortably, address some of the world's most complex risks. And as a result, as we're seeing those more and more arrive in the United States, whether they're due to different types of weather events, supply chain, new types of technology coming up that we haven't yet addressed from a risk mitigation perspective, our marketplace is perfectly positioned to address those.
Speaking of the Americas, you're taking over at a pretty critical time. This has been a strange year, to say the least, when it comes to extreme weather throughout the country. And, you know, we have seen, of course, very extreme weather in recent years, whether it's fires or floods that we're talking about here. So if you think about the impact this year alone has, how do you see pricing kind of shaking out moving forward? Because a lot of Americans have already been complaining about higher insurance prices for a whole host of other factors. And you take the weather alone this year, you have to imagine it's going to get a little worse.
Absolutely. And so pricing for sharing risk, transferring risk, is very complex. It's not a singular or a binary process. It's a combination of the returns, obviously, the capital is looking for, but also ensuring there's an element of risk mitigation and prevention into the mix. So, and as a third tier of that, very, very important, regulatory partnership. So we have seen multiple incidences, as you're showing here on the screen, of severe storms. We're seeing increased wildfire incidents around the world, hail, severe convective storm. So two things are happening. One, those instances are being worked into pricing. So we're making sure that we're accurately pricing for the risk that is being taken. However, globally and in our marketplace, we still have a fair amount and ample capacity available for catastrophic risk. And a second piece that is happening is around innovation. So Lloyd's Lab, which is an insurtech incubator we have, one of sort of the largest of 6 different innovation programs that we host at Labs, spends almost all of its time focusing on how do we deal with some of these new risks we're looking at. We have introduced businesses that deal with flood, wildfire, cyber downtime, all of these large-scale incidences that are hitting both consumers and commercial businesses alike.
And of course, we're sitting here talking to you in New York, but I do want to talk a little bit about Europe, if you can, because there's been extreme weather in the U.S. There's also been pretty record flooding when it comes to Europe. And I'm curious how that's changing dynamics and risk appetite and pricing when it comes to that market.
Absolutely. What's interesting there is traditionally, just over time, as a general statement, we have seen governments step in to assist when there have been sort of public natural catastrophes. And as times change and economies change, there's not as much of that funding available at times. And so we're seeing great opportunity for public-private partnerships to occur now. And we, along with our other insurance market peers, work with the marketplaces in Europe to say what is the best way to construct a solution, whether it's different types of national pools, risk management, mitigation measures, et cetera.
You hinted at this a little earlier, Dawn, the role of technology in the future of insurance. How are you thinking about that, particularly as you're taking over kind of a different division here in addition to your existing role at Lloyd's?
It's a great question. I see it in 2 ways. I'm very, very passionate about innovation and the fact that innovation needs to be integrated into business. It's not a unit on the side, considered something separate from everyone else. I think that at times creates some non-inclusive behavior. What's important is that we all understand that to innovate, it doesn't have to be scary. It's okay to fail. It's okay to fail fast and succeed even faster. So when I look at how we can bring Lloyd's Lab and other measures of innovation into the U.S. marketplace, it's how can we bring the risk mitigation and risk management, risk-taking expertise from our market to the great technological advancements that we see happening here in the United States. And this also takes me over to AI, right? AI is, as in every industry, becoming a huge driver of change, innovation, and opportunity for us. It's changing how our businesses operate within their own day-to-day business as usual. Maybe moving some of the more repetitive tasks away so that everyone's mind can be put on to more complex problem solving. Changing also how we calculate risk and also what we underwrite. Lloyd's has provided the first coverage for autonomous vehicles, as an example. And we're able to do that with the use of AI. At the same time, it takes me to the volume of AI computing, if I may call it that. AI usage that we'll have going forward will create an incredible amount of energy demand. And so that energy demand, we think creatively how we access that energy. And that in and of itself creates a need for new and innovative insurance opportunities.
Don, we thank you so much for joining us today. Of course, that is Don Miller of Lloyd's in the heat of a complicated insurance market, a lot of extreme weather and a lot of complexity in navigating it. We're now going to move on and get a check on the broader markets with Bloomberg's Abigail Doolittle.
We are looking at a seventh up day here for the S&P 500, Sonali. 7 up days in a row, the longest winning streak since mid-September. Today, just a fractional increase, though, at this point. So it will be interesting to see whether or not those bulls can stay in charge ahead of this holiday shortened week, or in this holiday shortened week, I should say, where maybe not all traders are at their desks. Where we do have some significant trading, though, is in the stocks that could be influenced by tariffs. Of course, President-elect Trump talking about 25% tariffs on all products from Mexico and Canada. Ford, and in particular GM, take a look at that. Session lows down 7.4%. They have more exposure, according to Bernstein, to their automaker plants in Mexico, plus the parts situation. So this stock, the worst day, going all the way back to June of 2022. Investors really a little bit nervous about what that 25% tariff could mean for GM and Ford. And then we don't have the particulars on China yet, but the SOX, which of course is one of the poster areas, chips for China trade, down about 0.6%. So stay tuned. And then finally, in terms of currencies, there's certainly a knee-jerk reaction for both the Canadian dollar and the Mexican peso. You can see the U.S. dollar doing better against them both when the news came out, and now recovering a little bit, more so for, interestingly, the dollar versus the Canadian dollar, but that peso still relatively weak.
Yeah, absolutely. Seeing a lot of dramatic moves in the currency market. Abigail Doolittle, thank you so much. Coming up, as we were just talking about, markets on high alert with Trump's latest tariff threats. We'll discuss how investors are bracing for any potential downside with Brandon Yarckin of Universa. This is Bloomberg.
There's been a record market rally underway, and it's been losing a little bit of steam this morning after Donald Trump vowed tariffs on China, Canada, and Mexico. Joining us now, Brandon Yarckin, Chief Operating Officer at Universa Investments. Universa has been bullish the last 2 years, which has been interesting given that Universa tends to make the most money when things go wrong. But this market melt up, you've been looking at it, you've been continuing on, expecting more of it ahead. But how long does that really run? I know you and your team are looking at a lot of risks under the surface.
No, sure. Thank you. And thank you both for having me. Predicting the end of cycles is impossible, but let's go back to 2022 and let's look at what we were thinking about, why we thought, the things look bullish. We were telling investors, one, empirically, we were at, you would see history and think we could easily go to 6,000 in the next 2 years, which was a bit of a controversial thing back then because we're a tail manager thinking everyone thinks that we're doom and gloom all the time. But there were two big macro factors that kind of tilted the scales to where, from a macro perspective, it seemed really compelling. One is the Federal Reserve is not in the business of causing crashes. The Federal Reserve is in the business of preventing crashes. So if the Fed is out there looking at the economic landscape and they see the economy so strong that they have to raise interest rates, it's typically a good period for stocks. Second, we have this kind of counter indication for positioning that sentiment back in 2022 is as bearish as we'd ever seen outside of the grand financial crisis. So what does that mean? That means back in 2022, you see all this history supporting a rally, yet people's positioning was for a sell-off. So that kind of can exacerbate things as sentiment changes, as the economic growth continued. And here we are, lo and behold, roughly 6,000 2 years later. And that was kind of what we were thinking.
What does your sentiment indicators tell you now? Because really what you guys are famous for, your scientific advisor, Nassim Taleb, traded through Black Monday. You guys know how to navigate options markets. And options markets today, are people really running to them to hedge, especially with volatility spikes like we've seen back in August?
No, I mean, that's a great question. 2 years ago, sentiment was very negative, contrasted with, particularly post-election, you're seeing sentiment kind of flipped on its head, which is what our CIO wrote about to our investors 2 years ago. So you see this kind of borderline euphoria from investors. You see the VIX at 14. You see that when walk in here. So it's starting to feel like this is the time when people should be preparing for the opposite of what we saw in 2022. And that's important because people come on shows like this all the time, and they will espouse their opinions about market's going to go up, it's going to go down, but where the rubber meets the road is positioning. And people back in 2022, you could have agreed with us and said, oh my gosh, I really like these guys. I think that their arguments are sound and I want to be bullish. But institutions and investors are constrained by risk, right? So if you knew the market was going to go up 72%, which is roughly what it's been up since then, you have the risk of being wrong and losing half your money or 40% of your money or something like that. That's a difficult thing to really take that conversation turn into conviction, to steal from Buffett.
Right.
Now, what we do and how we help people is to be longer by changing that dynamic. We tilt the scales a little bit, right? So instead of making 70% if you're right and losing 50% if you're wrong, what if we say, hey, instead of making 72, you could make 70% when you're right. But when you're wrong, now you only lose 20 or 10 or less. So now we start to care less about, is our forecast right? Is our empirical support right? Because we're changing the dynamics of how the investment itself performs.
Right. I do want to talk a little bit more about positioning because we often hear that this is a fully allocated market. You take a look at some of the surveys that are out there. What are you taking a look at when it comes to positioning? Because for all of those notes that I get from the sell side about how fully allocated this market is, there's still $7 trillion in money market funds. So what actually gives you conviction when it comes to positioning measures?
I mean, a lot of those metrics are noisy, right? Like you're saying, that you can look at one metric and it'll tell you one thing. You look at another metric and it'll tell you something else. And if you're very linear in your, so I want to go, we care less about the short answer is we care less about being right about things like that because we don't make and lose the same amount, right? Our clients, by allocating a portion of their capital to us, are able to change that relationship. So if they have a sentiment indicator and they think, oh my gosh, the market's about to crash, and they're wrong, they don't. The only way they could express it without having a position like us is to sell all their stocks, right? Or they sell a little bit, and it doesn't matter if they're right. If you can change that relationship, you can express that view much better, and then you don't really care if you're right or wrong because you're still doing so well when you're wrong.
So you kind of started off this conversation talking about how bullish you were to get started, but at what point does that change? What would make you change your mind about the direction of travel here? I
mean, we're getting close. I mean, if you look at, again, just those same big indicators, right? I mentioned two. There's a third, but I'll just go through two. One is the Fed, right? The Fed was looking at the economic landscape, and they felt so confident in the economy that they're raising interest rates. Right now, you go back to September, and they're looking at the economy, and they're actually cutting interest rates. Right. So historically, that's kind of started a clock of when people should start to be worried about the potential for a big drawdown in equities. Right. Second is sentiment, which we just discussed. Right. Back in 2022. I think sentiment was pretty broad spread that the market was very positioned to go down. Now, post-election, with Trump in office and efficiencies and lower taxes and all these business-friendly regulations, it certainly feels different. right? I mean, I'm assuming you share that sentiment. So now is the time to start thinking about, okay, well, what happens when that environment, that this optimism goes back to extreme pessimism? How do I plan? How do I prepare for that? And what happens if I'm early or if I'm wrong, right? And then how do you do that?
Well, Brandon, let's talk about that swing because it feels like this market, nothing can keep it down. You think about the last several years outside of the pandemic, of course, we've had hot wars. We've had this rolling recession, if you want to call it that. And we've seen a lot of stumbles, and it just seems like this market never comes down for very long. And I understand that, you're pretty bullish. You've been bullish for 2 years. But if you put on your tail risk manager hat, I mean, why aren't we seeing more of a reaction, more hedging, more of that pessimistic sentiment come through to very real events?
I mean, how they always say markets go up the escalator and down the chute, right? So the flip from euphoria to pessimism comes quickly because people are so positioned for up. They're not thinking about insurance right now. They're only thinking about not the risks. They're thinking about the reward of their positioning. So, we think that, based on history, the third thing that I had mentioned is equity valuations. We're at the highest recorded equity valuations outside of including the tech bubble, excuse me. So, we think we're much closer to 1929 than we are in 1996. But if we're wrong and you see a 50% rally, again, all that really matters is the positioning. So we're telling our clients be positioned for 1929, right? That's what they're doing with us is making sure they have these big, highly convex, explosive positions for crashes. But again, if we're early, if we're wrong, again, that risk-reward dynamic in their positioning is all that matters.
So riding the good times, preparing for the bad times. That is Brandon Yarckin of Universa Investments. Now, stick with us. We're going to talk more about a little bit of a New York City drama up next. We're going to bring you the latest on the New York City mayoral race. This is Bloomberg. The latest breaking on the ground here in New York City. Former hedge fund manager Whitney Tilson plans to join the race for New York City mayor. And he's going to be joining a crowded field that's seeking to succeed the embattled Eric Adams next year. A little bit about Whitney Tilson. He used to run a $200 million hedge fund firm, Case Capital Management. He's on the advisory board of Bill Ackman's Pershing Square Foundation, on the board of KIPP Academy Charter School in South Bronx. But he is entering, as we said, a really crowded field. Brad Lander, the current comptroller of New York City, the former New York City comptroller Scott Stringer, Queens State Senator Jessica Ramos are among those looking to run.
Yeah, and that primary coming up very quickly. It's in June. Of course, we've been so focused on the presidential election, but New York City mayor will definitely be interesting. Tilson entering the race here. And you think back to 2021, Ray McGuire, who you know very well, also ran in that primary, but it was hard. I mean, he came in 7th. He got just 3% of all the ballots that were cast in that race. So it's stiff competition. And I don't know, we'll see if he has the chops to actually bring in some voters.
It's a lot of headlines in a city that we've been talking about before has been changing very quickly. We saw a lot of information about the frustrations, the migrant crisis really coming to the polls, with a lot of the city turning red in very interesting areas, more than they had before in a traditionally very blue city.
Yeah.
And so also fiscal responsibility, big question mark. Also, of course, as we know, if we haven't mentioned it already, Adams was the first sitting mayor in New York City history.
I was going to say.
Federal corruption charges. He's fighting those charges.
Our current mayor obviously has a lot of baggage. He also has low poll ratings, related, of course, to the indictment on federal corruption charges. He's seen an exodus of top staff here. So it's going to be a very interesting Democratic primary when it comes to the mayoral race. And again, coming up in June. So we'll see Whitney Tilson entering the race here. We'll bring you more details as we have them. But let's get a check on these markets, of course. It's an interesting trade. We have a whole ton of retail earnings. We have tariff threats on top of that. A little bit of a pun there by accident. You take a look at the S&P 500 in any case. We're up about 0.3%, and it's big tech that's your leader, at least for this moment. The NASDAQ 100 up about 0.4%, a sell-off underway in the bond market. Coming up tomorrow on Open Interest, we'll speak to the points guy, Brian Kelly. Holiday travel season ramping up. We're almost to Thanksgiving. This is Bloomberg.